Hey guys, welcome back to the channel. So we're going to be talking about dividends today, right? What is a dividend? Why you should care about dividends? How I feel about dividends? Spoiler alert, fantastic, right? So let's get into what a dividend is, right? Because a dividend is the distribution of some of a company's earnings to a class of its shareholders, right? As determined by that company's board of directors, right? Common shareholders of dividend paying companies are typically eligible as long as they own the stock before what's called the ex-dividend date. Dividends may be paid out as cash or in the form of additional stock, right? So, dividends must be approved by the shareholders through voting rights, right? So, if you own shares in a company, you have the right to vote whether you want that company to pay dividends or not. Although cash dividends are the most common, dividends can also be issued, as shares of stock or other property. Along with companies, various mutual funds and what are called ETFs, exchange traded funds, they also pay dividends. So a dividend is basically a token reward paid to the shareholders for you putting your money in a company's equity, right? It usually originates from the company's net profits. And while the major portion of the profits is kept within the company as retained earnings, basically, which represent the money to be used for the company's ongoing and future business activities, the remainder is going to be allocated to the shareholders as that dividend, right? So at times, companies may still make dividend payments even when they don't make enough, like profits, like their profit levels aren't what they want them to be, or maybe they're really low and they're barely getting by. Like there's a lot of companies will still make those dividend payments. They may do this so that they can maintain their established track record of making regular dividend payments, right? The board of directors can choose to issue dividends over various time frames and with different payout rates, right? They can be paid at a scheduled frequency like monthly, quarterly, or annually, right? So like let's take Walmart for example. They make regular quarterly dividend payments, right? Companies can also issue non-recurring special dividends, either individually or in addition to a scheduled dividend, right? Backed by strong business performance and an improved financial outlook, like Microsoft Corporation, like Microsoft declared a special dividend of $3 per share in 2004, which is way above the usual quarterly dividends in the range of about, I think it was like 10 to 16 cents per share, right? So, you need to look at dividend paying companies, right? Larger, more established companies, like we talked about Microsoft and Walmart, right, with more predictable profits, are often the best dividend payers. These companies tend to issue regular dividends because they seek to maximize shareholder wealth in ways aside from normal growth. Companies in the following industry sectors we're going to talk about, they're observed to be maintaining a regular record of dividend payments, right? So these industry sectors are like basic materials, oil and gas, banks, financial, healthcare and pharmaceuticals, and utilities, right? Companies structured as what's called MLP or Master Limited Partnerships and real estate investments or REITs. They're called Real Estate Investment Trusts, REITs. They're also top dividend payers since their designations require specified distributions to shareholders. Funds may also issue regular dividend payments as stated in their investment objectives. Startups and other high growth companies, such as though in the technology, biotech sectors and stuff like that, they may not offer regular dividends, right? But because these companies may be in the early stages of development and may incur high costs or high losses attributed to research and development, business expansion, operational activities, they may not have the money, to actually issue dividends, right? They're trying to make a profit first, right? So even profit making, early to mid stage companies avoid making dividend payments if they're aiming for higher than average growth and expansion, right? And they want to invest their profits back into their business rather than paying that dividend, right? So let's talk about some important dividend dates, right? So some of the important dividend dates, the dates, they follow a chronological order of events, and the associated dates are important to determine the shareholders who qualify for receiving that dividend payment, right? So you have the announcement date, right? Dividends are announced by company management on the announcement date and must be approved by the shareholders before they can be paid, right? Then you have the ex-dividend date. The date on which the dividend eligibility expires is what's called the ex-dividend date, or simply the X date. Like, let's take an example. If a stock has an ex-dividend date of Monday, May the 5th, right, then the shareholders who buy the stock on or after that day will not qualify to get the dividend, as they're buying it on or after that dividend expiration date, right? Shareholders who own the stock one business day prior to the ex-dividend date, which would be, since that's a Monday, the business day would be Friday, so that'd be Friday, May the 2nd, or before that, they will receive the dividend, right? And then we have the record date, right, or record date, is the cutoff date, established by the company in order to determine which shareholders are eligible to receive a dividend or distribution. So the last one is going to be the payment date. That's when the company issues the payment of the dividend on the payment date, which is when the money gets credited to investor account, right? The impact of dividends on share price is also another thing to talk about. Since dividends are irreversible, their payments typically lead to money going out of the company's books and accounts of the business forever. Therefore, dividend payments impact share price, which may rise on the announcement approximately by the amount of the dividend declared, and then decline by a similar amount at the opening session of the ex-dividend date. So let's do an example. Let's say a company is trading at about $60 a share, and they're going to declare a $2 dividend on the announcement date. As soon as that news becomes public, as soon as they announce that, the share price shoots up by around $2 and goes from 60 to 62. Now, say the stock trades at 63 one business day prior to the ex-dividend date. On the ex-dividend date, it adjusted by $2 and begins trading at 61 at the start of the trading session on the ex-dividend date, because anyone buying on the ex-dividend date will not receive the dividend, right? So keep in mind, the only guarantee is the price adjusts lowering the share price by the dividend on the ex-dividend date, right? So, like, why do companies pay dividends? Like, what types of companies pay dividends, right? So companies pay dividends for a lot of reasons. These reasons can have different implications, interpretations for investors. Dividends can be expected by the shareholders as a reward for their trust in that company. The company management, they might aim to honor this sentiment by delivering a really good track record of dividend payments. Dividend payments reflect positively on a company, and they help maintain investors' trust. Dividends are also preferred by shareholders because they are treated as tax-free income for shareholders in many countries, right? Conversely, capital gains realized through the sale of a share whose price has increased is considered taxable income. Traders who look for short-term gains may also prefer getting dividend payments that offer instant tax-free gains. A high-value dividend declaration can indicate that the company is doing well and has generated some pretty good profits. But it can also indicate that the company does not have suitable projects to generate better returns in the future. Therefore, it's utilizing its cash to pay shareholders instead of reinvesting it to try and push their growth, right? If a company has a long history of dividend payments, a reduction of the dividend amount or its elimination may signal to investors that the company is in trouble. The announcement of a 50% decrease in dividends from GE, right, General Electric, It's one of the biggest American industrial companies, if you don't know who they are. It was accompanied by a decline of more than 6% in their stock, right? This was 3 years ago, 4 years ago, something like that. A reduction in dividend amount or a decision against making a dividend payment, it's not necessarily going to translate into bad news about a company or for a company, but it may be possible that the company's management has better plans for investing that money given its financials and its operations. So let's do an example. A company's management may choose to invest in a high return project that has the potential to magnify returns for shareholders in the long run, as compared to the small gains that those shareholders will realize through dividend payments. All right. So let's give some notes about some, like fund dividends, right? So dividends paid by funds are different from dividends paid by companies. Company dividends are usually paid from profits that are generated from the company's business operations. Funds, they work on the principle of net asset value, or NAV. That reflects the valuation of their holdings or the price of the assets that a fund may be tracking. Since funds don't have any intrinsic profits, they pay dividends sourced from their net asset value, right? That NAV. So, due to the NAV based working of funds, regular and high frequency dividend payments should not be misunderstood as a stellar performance by that fund, right? So let's say like a bond investing fund may pay monthly dividends as it receives money in the form of monthly interest on its interest bearing holdings. The fund is merely transferring the income from the interest fully or partially to the fund investors. A stock investing fund may also pay dividends. Its dividends may come from the dividends it receives from the stocks held in its portfolio or by selling a certain quantity of stocks. It's likely the investors receiving the dividend from the fund are reducing their holding value, which gets reflected in the reduced NAV on the ex-dividend date. So are dividends irrelevant, right? So there's this calculation, there's these economists named Merton Miller and Franco. I'm not gonna be able to pronounce his last name. Modigliani. They argue that a company's dividend policy is irrelevant and it has no effect on the price of a firm's stock or its cost on capital, or of capital, sorry. Theoretically, a shareholder may remain indifferent to a company's dividend policy. In the case of high dividend payments, they can use the cash received to buy more shares. Reinvesting dividends is often a smart choice, though it isn't always the best option. So, like, let's say in the case of low payments, they can instead sell some shares to get the necessary cash they need. In either case, the combination of the value of an investment in the company and the cash they hold will remain the same. So these two guys concluded that dividends are irrelevant and investors shouldn't care about the firm's dividend policy since they can create their own, like, synthetically, right? However, in reality, dividends allow money to be made available to shareholders, which gives them the liberty to derive more utility out of it. They can invest in another financial security and reap higher returns, or spend on, other leisure and utilities and things like that. Additionally, costs like taxes, brokerage, and invisible shares make dividends a considerable utility, like in the real world, like realistically. Dividends can help to often offset costs from your broker and your taxes. Ultimately, this can make dividend investments more attractive, right? Of course, to get invested in dividend earning assets, a lot of people think like you need to be like a stockbroker, right? But like you can go get M1 Finance, Robinhood, Webull, any of the, or Public, like a lot of these. I think even Cash App, you can do it on Cash App. So like you can invest in any of these companies, right? A lot of people are like, I can't invest in these companies because blah blah blah. Yeah, you can. So buying some dividends, right? So investors seeking dividend investments, they have a number of options, including stocks, mutual funds, ETFs, and a whole bunch of other things, right? The dividend discount model or the Gordon growth model can be helpful in choosing stock investments. These techniques rely on anticipated future dividend streams to value shares. To compare multiple stocks based on their dividend payment performance, investors can use the dividend yield factor, which measures the dividend in terms of a percent of the current market price of the company's share. The dividend rate can also be quoted in terms of the dollar amount each share receives, or dividends per share, right? In addition to the dividend yield, and another important performance measure is to assess the returns generated from a particular investment is the total return factor, right? And that's going to account for interest, dividends, and increases in share price, right, among other capital gains. Another thing is tax. Tax is another important consideration when investing for dividend gains. Investors in high tax brackets are they prefer dividend paying stocks if the jurisdiction allows zero or comparatively lower tax on dividends than a normal rates. For example, Greece and Slovakia have a lower tax on dividend income for shareholders, while dividend gains are tax exempt in Hong Kong, right? So my personal thoughts on dividends are they're amazing. I think anyone who's getting into investing, they should look to start in dividend investing first. The only other thing is I would say maybe invest in like a fund that pays dividends would be the easiest thing. Just find a really good fund that say tracks like the S&P 500 and just invest in that, right? If you don't want to do your own research into individual companies and stuff like that. I really hope you guys enjoyed this video. If you could, go ahead, go down, give me a comment. If you liked the video, give it a thumbs up. Subscribe, you can see some more videos. And until I see you guys in the next video, y'all be good.